The next recession will be in... Okay, that's not a typo. To reach the best guesstimate of when the next recession will begin, we need to understand how the Federal Reserve creates unsustainable booms and why the next bust may not be very far away. Fake it till you make it might work in Silicon Valley, but it is a less practical strategy for the Federal Reserve, which looks ready to compound one mistake with another. The US inflation rate topped 7% in the last month of 2021, a fresh high since June of 1982. Now the Federal Reserve is ready to raise interest rates starting March of 2022 in an effort to bring inflation under control. In response to Federal Reserve's decision to raise interest rates in 2022, the stock market has been all over the place, up and down and sideways. But even if the market bounces, and it will bounce, investors have to know that the clock is ticking down to a recession and the end of the bull market. The clock in this case is the yield curve. And an inverted yield curve is one of the truly reliable signs of a recession. The yield curve reflects the short, intermediate, and long-term rates of the US Treasury bonds. These rates are a reflection of buying and selling of bonds in the open market. In general, short-term bonds carry lower yields to reflect the fact that investors' money is at less risk. And the thinking behind this is that the longer you commit funds, the more you have to be rewarded for that commitment, or rewarded for the risk you take that the borrower may not pay you back. This is reflected in the normal yield curve, which slopes upwards from left to right on the graph as maturities lengthen and yields rise. You will generally see this type of yield curve when bond investors expect the economy to grow at a normal pace without significant changes in the rate of inflation or major interruptions in available credit. There are times, however, when the shape of the curve deviates, signaling potential turning points in the economy, and that is when the inverted yield curve comes in. At first glance, an inverted yield curve seems counterintuitive. Why would long-term investors settle for a lower reward than short-term investors, who are assuming less risk? As you might expect, since lower interest rates generally mean slower economic growth, an inverted yield curve is often taken as a sign that the economy may soon stagnate. While inverted yield curves are rare, investors should never ignore them. They are very often followed by an economic slowdown or an outright recession, as well as lower interest rates along all points of the yield curve. This is not just a signal that a recession is coming, it also creates a condition where lending is no more profitable for banks. Ultimately, the lack of credit causes a recession, though it may take months to occur. Now let's talk about the current economic environment. The yield curve is quickly flattening, and if the market follows the historical path, recession usually follows between 8 and 19 months, which would put the next recession in the middle of 2024. This, of course, is all speculation at this point, since much of this will depend on how serious Powell is about raising interest rates to tackle inflation and the path of economic growth. The first sign is often an asset bubble. In 2008, for example, it was the housing crisis. The 2008 financial crisis was worse than any other crisis except the Great Depression. The first warnings came in 2006 when the housing prices started falling and mortgage defaults began rising. The Fed and most analysts ignored it. They welcomed a slowdown in an overheated housing market. Then, in 2007, the subprime mortgage crisis hit. Lenders had allowed too many people to take out subprime mortgages. When they defaulted, the banks called in their credit default swaps. That drove insurance companies like American International Group to bankruptcy. By midsummer, the banks had stopped lending. If we go back even further, in 2001, it was the high-tech stock market prices. It is usually accompanied by a feeling that everyone is getting rich beyond their wildest dreams by investing in assets. The next warning is the get-rich-quick ads everywhere. You feel like you are being left out. And this is true to some time leading up to the crash. That's the nature of an asset bubble. The third symptom occurs when self-proclaimed experts write books predicting prosperity beyond wildest imagination. They say that this time it's different. It's called irrational exuberance. It could last for months or even a year or two, but it never lasts forever. Though 2022 is unlikely to host a recession, 2023 and 2024 are extremely risky. The Federal Reserve will begin rising rates starting of March 2022. The economy usually reacts with a time lag of about 1 or 2 years, plus minus. The greatest risk in the near term is that the Fed realizes that much of the recent inflation is long-lasting rather than just transitory. Can a recession be completely avoided in the next few years? Theoretically, it is possible. The Fed would have to tighten at the right time, in just the right magnitude, then return to neutral at just the right time. It could happen, but the odds are very, very slim. The people at the Fed are smart and knowledgeable, but the task is too difficult. So businesses should enjoy their gains in 2022 while developing contingency plans to be ready for the nearly
inevitable recession.
If you find yourself suddenly out of a job or trying to get by a lower income, an emergency fund can get you over the rough patch. If you don't have an emergency fund, now is a great time to start one with high yield savings account. If you already have one, consider building it a bit more. Experts typically recommend keeping enough money in your emergency fund to meet all your expenses for 3 to 6 months. The bad news is most Americans don't have nearly this much saved up. According to a 2020 Bankrate poll, more than half Americans don't have enough savings to cover even a $1,000 unexpected expense. If you're part of this group, adding to your emergency fund should definitely be a top priority. Crunch some numbers to figure out how long your savings would last in different situations.